Nicholas Borneus of CPLP, I would like to welcome you to a very interesting panel discussion that will follow on the LNG sector. LNG right now is energy overall, and LNG in particular, I think, is at the very top of the discussion list. With everything happening in Europe, with everything happening around the world. So we look forward to a great panel discussion. Christa Volpicelli, our partner in putting together this conference, is going to moderate the panel. Thank you, Christa. And I'd like to welcome and thank Spyros, Paolo, Karl, and Oystein, and Christa, the floor is yours. Thank you.
Great. Thank you, Nicholas. Thanks, everyone, for joining. Very exciting panel and quite topical, given everything that's happening in the world. Maybe before we just kick off into the topics, because each company on this panel has a slightly different focus in terms of how and where they're playing in the LNG chain, why don't we just kind of go and everyone can give kind of a 30-second introduction of their company's specific area of focus, just to level set the discussion, and then we'll jump into some topics about the market. So I'm just going to go in order of my screen. Oystein, maybe turn to you first.
Yeah, thanks, Christa, and good to be here. Flex LNG is a fairly comprehensible company to understand. We have 13 modern new LNG carriers, all fitted with the latest propulsion system, MEGI and XDF. All the ships have now been delivered. We had our 3 last ships delivered last year. 13 ships, it's a market cap, depending a bit on the stock market, $1.5 billion. So it's a relevant size, relevant liquidity in the stock. We are paying a juicy dividend of 75 cents quarter, translating into $3 on an annual basis, which should give you a yield a bit depending on the share price of 11–12%. And we also been busy last year also booking long-term charters. So we have a very good backlog and basically booked for the year.
Excellent. Thank you. Spyros?
Yeah, thank you, Christa. So as Capital Group, so we are actually I would say, among the panel, probably the new entrants in the LNG space. We have 6 vessels trading at the moment that are dropped down to the public company, CPLP, and we have another 6 vessels on order on the private side. All of the vessels are XDF, all the vessels trading are XDF, and we have 5 new vessels coming, which are mega, the new technology that lowering methane slip. We are focused on, I would say, mid to long-term charters, providing cash flow visibility, and it's a pleasure to be in the panel. Thank you.
Thank you. Paolo?
Hi, Christa. Thank you. So GasLog has really 2 souls. One is the private side, and the other one is the GasLog Partners, the MLP listed. We have a total of 36 ships in the water and 4 new buildings. 16 vessels are the latest 2-stroke technology. We have some TFDs and steams, and we're an infrastructure player in an industrial player. We have a long-term relationship with oil majors and differentiated portfolio of customers. We've also started on the FSRU and FSU space with different partnerships. So, really looking forward to talking with the other colleagues here and you on this very interesting panel.
Thank you. And last but not least, Karl?
Yeah, hi everyone. So I represent 2 companies today. Golar LNG. We are an LNG company mainly focused on floating liquefaction. We're listed on NASDAQ with a market cap of $2.4 billion. We also have one of the world's most modern FSRUs promptly available. And we also own a steam carrier called the Arctic. I'm also representing Cool Company, a newly formed shipping company with 8 TFDE vessels on the water. We have a market cap of $440 million approximately. We had 2 ships coming open in April, and we recently fixed one of them at $120,000 a day, representing free cash flow to equity of around 50% in 1 year. So a lot of things going on for both companies, especially in light of the geopolitical changes. And I think LNG on a relative basis have become even more important in the global energy mix than it was earlier in the year. So excited to be here and to be part of this panel.
Great. Thank you all. So I'd like to start with talking about the current backdrop situation with Ukraine. And maybe we'll talk first about the shorter term and then transition into the longer term impacts, and everyone can get their crystal balls out. But let's talk about the near term impacts of the geopolitical events. Seems that the time charter rates have responded more than the spot market. But could you talk a bit about kind of the current LNG shipping rate environment, what you're seeing in terms of cargoes, rates, and any other comments that you'd like to make about kind of the near-term impact that we've seen over the last several weeks? Happy for anyone to start, or I can maybe I'll pick on Paolo first.
Sure. Yeah, I think the way you pictured it is really the dynamics today. The market has completely changed for all the wrong reasons, because it's happening on the back of a conflict that no one would like to see. And as Karl mentioned at the beginning, we believe that the genie is out of the bottle and is not going to go back. So energy security now is as important as energy transition, and this is reflecting on long-term and medium-term rates and all the dynamics of energy security policies and steps that are being taken, not only on shipping, but really fundamentally at the infrastructure level. All of this is in a scenario where gas prices therefore remain very high, because there's still a very strong competition between the two basins in attracting molecules, and there are very strong commitments for Europe to be continuing down this route even through the whole winter. So I think we can all expect that the molecule price will remain relatively high. This has somehow put the spot rates relatively under pressure. One, because the existing ton-mile now is definitely shorter than the one you will normally enjoy, with a spread between JKM and TTF going up towards Asia more than Europe. So that's one thing. The other thing is the overall pricing. They are, let's say, providing healthy returns depending on what kind of structure or offtake you have, but they're also sort of hurting some of the demand in the Far East. Now, all of this is really, let's call it a very short dynamic, because we can see, the amount of available vessels, and I think we've heard Oystein and Karl also mentioning the amount of vessels that they have opened, but the amount of vessels open from independent owners are very few this year, and therefore there's a healthy discussions on term rates, because no one wants to be exposed and be short shipping in a market that is so dynamic and unpredictable. So I think that's what that's my contribution to this very interesting question, Christa.
I think I can elaborate a bit, but the LNG market is obviously cyclical and seasonal. Typically in a normal year, the seasonal softer part of the year is sort of spring and summer months, and the strong part is in the winter months. It has to do with when it's cold in the northern hemisphere. But what we see right now is that we had basically, and it's almost easy to forget already, but we had record gas prices in December. In December, gas prices was higher than what they are even today, despite the geopolitical unrest and the whole Russia-Ukraine situation. So the LNG gas market is tight fundamentally before geopolitical shocks. What happened was that rates came from almost $300,000 a day in December, down to around 30,000 in sort of February, March. And they remain under suppressed levels for some of the reasons that Paolo just highlighted. However, the call it scramble towards energy security and securing capacity from the very few independently owned ships available this year has caused term rates to be significantly higher than the spot market, and also significantly up year to date. So interestingly, the spot rates are even higher today than what we saw in December. I think energy security is a important part of it. Lack of available ships from, or a limited amount of available ships from independent owners is a second part of it. And thirdly, which I'm sure we'll speak more about later on, but new environmental regulations coming into effect from 1st of Jan 2023 has also made some charters be somewhat ahead of the curve to fix capacity well into next year. So I think those are really three of the arguments why we see these term rates picking up.
Just to add on that, I would say, you know, for one element that I think it's worth pointing out is that the way we see the market is more based, is a commodity-linked market rather than a shipping-linked market, meaning that we see, I think, the delta between different asset classes like steamships, DFTs, and two-strokes is widening as the commodity is expected to remain at those levels, at high levels at least. So we think, you know, that as long as the outlook, I think that's the difference that the war in Ukraine has made, is that the outlook for the commodity is very, very bullish. So we think that, you know, we will see a commodity-driven price, meaning that charters will go and secure more efficient tonnage, and that's why I think that we would say widening, let's say, delta between the different asset classes. That's something to expect, I think, probably in the future.
As the time charter rate has strengthened, what are you seeing in terms of trends for duration of time charters? Has that changed?
Maybe I can add a bit. Of course, when you have a very strong market and people are being quoted these 12 months time charter rates for tri-fuel ships, and of course with the high, as Spyros mentioned, you know, more efficient ships, you know, we are basically ships that eat off the cargo, and the cargo these days are very valuable. So with more efficient ships, the delta between the different asset classes, steam, tri-fuel, and the mega XDF mega ships should widen. And actually, you know, these kind of product prices is probably going to do as much for scrapping of older tonnage than the EEXI coming into force January 1st. So when we get kind of elevated term rates for 12 months, then of course people are asking, okay, what if I do 3 years in order to smooth the rate? And then maybe they don't like that number either these days. So then we are getting into 5. So we do see more inquiries these days for prompt time charter for durations 5, even all the way up to 10 years. And usually that's not something you see in a spot market, where spot market rates are at, let's say, 60,000, and then you can at least more than double that for a 12-month time charter. But you know, the 12-month time charter rate is a very good proxy on where the spot market will go. And of course, if the term rates are at such level, that also affect the sentiment in the spot market. So that's pushing that up. And usually when we have this conference, this is around the bottom of the market usually. This year the market bottomed a month earlier because of, let's say, a concern by the big charters that they don't have access to tonnage. And having access to tonnage these days is crucial given the product prices, because suddenly if you have a cargo worth in excess of $100 million and you're not able to ship it, you have to kind of liquidate that product to other people with shipping and sell it at a loss. So in the greater scheme, the freight rate is not that big impact on the overall economics. So it looks good now. Of course, in general, the reason why the spot market are at such low level is, of course, as the other people mentioned, there is the ton mileage effect. A lot more cargoes are going into Europe, which usually isn't good for the shipping market. We saw the same thing back in 2019 when volume growth was high and everybody had big expectation for the freight market, but it stayed soft until let's say the autumn because of the pull to Europe. Now we're seeing the similar pull to Europe, but we also see more kind of friction in the market, which is then driving up these term rates.
And that's a good point, Oystein, because even if it's not good for ton miles, it's a lot of inefficiencies when all of these ships are redirected to Europe. So even if it's better for us that we go US-Asia than US-Europe, this current market is not very efficient US-Europe compared to frictionless market.
So then how do you transition that view into the longer term, right? Energy security, where does Europe get its gas? The US EU deal in terms of adding more production through 2030. How do you think some of the longer term impacts might impact the LNG shipping market?
I think from our side, what we see is like a stabilizing bullish LNG market. I mean, the market was already quite, the fundamentals were quite strong. I think this crisis, they will be only stronger. We were, I think, initially with the high prices before the war broke out, there was a concern about demand destruction in Southeast Asia, which I think now has been tempered because we see that Europe effectively can absorb as much LNG as gets produced. So we expect that a lot of FIDs will actually be completed within the year in the US, and other projects like probably Mozambique will kickstart again. So we'll see. I would say for us it's like only bullish LNG. Also, I think we'll help as the environmental discussion continues, and gas has now been in the EU taxonomy, has been included in the EU taxonomy. So with that, I think that the place that we were always seeing that LNG has as a transition fuel, I think now it's actually getting materialized more and more as we move forward.
Yeah, I would agree with Spyros. In the long term, of course, the outlook for LNG has become much better because you need to replace probably a big chunk of pipeline gas, and then the only alternative is LNG. And I do think we will see a wave of FIDs in US. So even if a lot of these cargoes are going into Europe, it's still a lot more cargo. And actually these days, historically, it's been like you build LNG upstream projects, they are delayed, and then the ships are early, and you have too many ships. These days, actually, it's quicker to build a LNG export plant than a LNG ship. Calceus Pass, they managed to, from they pushed the button until they started the loading cargoes, it took 29 months. Today, if you order an LNG ship, you get it in 2026. So kind of the time to market for some of these, especially US projects, it has been reduced a lot. The risk has been taken down a lot, while actually the LNG new building market is very tight. Prices are very high, and actually because of all the container orders. So it means that it's getting harder to get LNG carriers, in the next couple of years. Also because we are competing with Qataris, who's going to be ordering a lot of new LNG carriers for their increased activity as well.
Yeah, and I think a good example of all of this is if you look at the amount of FSRUs that were available in the market at the end of 2021 and the one that are being fixed now. I mean, every FSRU that doesn't work as an LNG carrier actually becomes a very important utilizer of vessels. Depending on the weather conditions, you're talking about one or two cargo, maybe sometimes 3 cargoes a week. So all of these overhang of capacity, which is being translated into a very interesting opportunity, especially on Europe, is also adding up to taming down whatever effect you have on ton mile. So I think in general we see that there's a new paradigm for LNG, and in a way that will be facing with 2022 and 2023, where you have relatively low and mostly committed new building deliveries, and an important growth, especially from new FIDs, which are going to probably meet the 2025-2026 years of relatively large new building growth. So we're coming up we're continuing the tight market that we were mentioning before, and coming up to even more equilibrium on the highest year for delivery in a few years to come.
I think just to add to the discussion here, week before last, we were invited to meet Robert Habeck, which is the Vice Chancellor of Germany. He said, irrespective of the outcome of the current Russia-Ukraine situation, Germany has now taken a strategic decision to diversify its energy sources, or mainly gas sources. Whatever the outcome, they cannot be as dependent on one single source for gas. So for us, I think the LNG market, which I alluded to, was already tight before this situation, has now seen a massive demand pull that Spyros and everyone has touched upon. I think for Golar, that's obviously interesting, as we have one of the most modern FSRUs promptly available. But I think even more so, it's interesting because we are into the floating liquefaction. That means that we can monetize stranded or associated gas fields. If we took FID today, within 3 years from today. So even if you compare that to the US-Germany 50 million tons gas deal, or even the Qatar to Germany gas supply deal, we are able to source gas from any stranded or associated gas resource quicker, more environmentally friendly, and promptly if they enter into an offtake agreement today. So for us, I think what's going on in this market should bode well for all parts of the LNG infrastructure chain, all the way from liquefaction, shipping, and to import terminals.
Christa, if I may, an interesting point is that Karl was saying that it will take 3 years from FID to develop an FLNG, while now I think it's more than 3 years to actually build an LNG carrier. So you need to find shipping to develop to transfer that LNG from the new fields. And I think that touches on what Oystein was saying on the scarcity of slots in the shipyards, which I think will be a constraint factor going forward. We see now shipyards are not even quoting prices for, and the first available slots are 2026. Together with the outlook for high commodity prices and the demand for two-stroke vessels, this creates a very interesting environment, especially for people who have open vessels and companies like Oystein and us. So we'll see. Yeah,
I guess we need to speak more off the video as well then.
Yeah, maybe.
So Spyros, thank you for that comment. And Oystein, you mentioned the order book as well, and in particular, the fact that there's a lot of yard slots being taken by the container shipping sector. But I guess talk about the order book relative to the fleet on the water for a minute, because compared to some other segments of shipping, whether it's tankers or dry bulk, you look at the LNG order book relative to the fleet on the water, and some might say it looks a little bit high. So you comment in terms of the status of the existing LNG order book relative to the assets out there today, and how you see that impacting the medium-term environment.
Yeah, I think there's two big differences. So let's compare it to tankers and bulkers. So order book in tankers and bulkers are not very big, admittedly. But if you look at tankers and bulkers, they are rather stagnant markets. It's not a lot of growth in those kind of segments. And also, if you look at those segments, you don't have any single ship running on steam propulsion. So it's a bit odd with LNG shipping, where you have still close to 200 ships running on obsolete, I would say almost, sorry Paolo, steam propulsion, which is not very efficient. So you will have a much higher level of attrition when EEXI coming into force January 1st next year than other segments. So the order book is elevated because of a phase out of older steamships, and also because we are in a market which has been growing 8-9% every year. Of course, this growth will probably slow, and maybe the growth factor going forward the next 20 years will be 3 or 4%, but still it's a pretty robust growth compared to most other shipping segments.
Thank you. Any other comments on that point?
We agree.
So maybe we can shift to the regulatory side for a minute. And I'd like to talk about some of the new regulations coming into play, specifically EEXI, January 2023. What does that mean for the LNG shipping fleets and what folks should expect?
I think Oystein spent quite a lot of time explaining it. So basically you have these two new regulations, the EEXI and the CII. EEXI will mean that most steam carriers will need to slow speed in order to meet the new requirement. That will make them even further uneconomical or inefficient, which makes us believe that they will not take an active part for long-haul international trade. They might be on shorter haul intra-basin trades until they're initially phased out. Then you have the CII, which is a rating system. And most of the majors are saying that they will only deal with ships that are A or B rated. And there are certainly no steamer that will be neither A nor B. They will most likely be D or E rated. So if you get that type of rating, you're secluded from a lot of business. You're way inefficient today, and you're even more inefficient from 1st of Jan 23, which is the reason why, as Oystein explained, the order book versus the fleet on the water is pretty much the order book matches the steamers. So if it was all happened at the very same time, you're looking at a very marginal fleet increase because the new ships are slightly larger than the ones they replace. But the vessel count is very similar.
Yeah, maybe just a comment on this, and not because we have 16 vessels, because it's 6 out of 40, so it's still a relatively small part. But it really is about the not only how efficient is the vessel, but how efficiently you use it. There's a very interesting Bureau Veritas study that shows that you can actually very quickly move 2 categories, so from A to C or from B to D, depending on how your asset is being used. And of course, the regulations are still being finalized, but that is the sort of the gauge that the way you manage your speed or your cargoes or your laden time affect your probability to be able to run in one category or the next. And I think that happens through the whole spectrum of vessels. So I fundamentally agree with the fact that there's a potential for a relatively large part of the tonnage to be at some point disposed of, especially as it comes fully paid out of long-term contracts. But I think there's also maybe a point that the quest for energy security will reflect on the quest for tonnage to be on the water, perhaps a little bit longer than it would have been without this paradigm change. And the fact that, the steam vessels, they will have to slow down. I mean, all of them will need to slow down. But in fact, if you see the average speed of steam vessels was around 14 knots, 14.3, and most of the steam vessels will still have the capacity to go around 15 knots. So in terms of overall possibility and capacity, absolutely. But how much of this is going to translate into a real impact on the water? I mean, I think it's a little bit less linear than it would have been without the recent events.
Yeah. Another factor is, of course, the scrapping prices these days. Steel prices, nickel prices, aluminum prices, they are pretty high and elevated. So that is also another factor that will incentivize early retirement for these steamships.
I agree. I think, an important factor is just the daily difference between a steamship and a 2-stroke vessel. So apart from the EEXI, as Oystein was saying previously, there will be a huge incentive to scrap older vessels just because of the daily difference. At current gas prices, we're talking about $500,000, up to $500,000 per day difference. So that's a lot, and it's difficult for charters to take that in. So I think that will push, and the visibility that we have now that commodity prices will remain high, I think that will push more steamships out of the market.
Great. I'm going to take a couple of questions that have come in by the audience. So thank you to those who are submitting questions. Feel free to do so in the Q&A chat box. One question that has come up is just for the panelists to comment around, is there sufficient infrastructure with regasification facilities around the world, and I guess with a particular emphasis on Europe, given what's happening in the world. And Karl, you talked a bit about your Germany discussions, but any other comments in terms of what if there needs to be a greater buildup on the regasification side?
The short answer is the need to do more import projects. And if you take Germany, which is one of the largest gas consumers in Europe, they don't have import terminals for LNG because they get all their gas in a pipe from Russia. They have recently gone out this week to secure 3 FSRUs. So the short answer is yes, we need more import capabilities, in particular in Europe, to offset Russian pipeline gas. And that is why there's such a lot of emphasis and interest on FSRUs promptly available these days.
Yeah, I agree with Karl Fredrik. It's not only Germany. We do see FSRU projects or import terminal projects in UK, where we're looking into a reboot of Teesside, also Italy. So of course, the regasification capacity in Europe is unevenly divided. So on the Iberian Peninsula, you have a lot of regas capacity, but they don't really get a lot of the gas from pipelines. So they are not really the one feeling the pinch these days. So for sure, I do think there will be more import terminals being built in Europe, both FSRUs and kind of fixed import terminals.
No, for this question, I think it's important. If you see the utilization of regasification facilities, it has been relatively low traditionally, I mean around 45 to 50% maximum. But that doesn't mean, that doesn't take into account the seasonal peaks. And I think that's the important, and also the exact location of the regasification, especially in Europe. And it's a matter of, it's not so much of market rather than, I would say, strategic independence that leads the demand for FSRUs and regasification facilities.
Yeah, and I think following what Spyros mentions, if you think that Europe is getting out of this winter with about 28% of storage, and the ambition is, or the mandate in some cases is that by September, the storage will, or at least the critical ones, will need to be between 80 and 90% full. Then you realize it's not only, it's really a combined race that is creating all this momentum. One is creating additional regas capacity, making sure that you have your storage up and to the level that you want, and then also deploy additional storage and feed the FSRU. So it's a very interesting market dynamic developing all around it.
Okay, thank you. We had another question very specific to Japan and the importance of the Japanese market to your strategy. So any comments there?
I can just comment maybe that, Japan has been traditionally the biggest market, was the biggest market until last year. Europe is feeling the pinch now with these high product prices, but Japan have covered all their needs with contracted LNG on long-term contracts linked to oil at, typically 15 to 25% discount to the oil price. So Japan is a big market, but it's a mature market. It's a bit of a protected market in terms of the utilities there and how they price. They're not really in the same way as more the spot-oriented gas market in Europe. Regas capacity is high, so I don't expect them to run to the market sourcing FSRUs. But in general, they are doing pretty well because they have secured the LNG they need.
Okay. On the last panel on capital allocation, there was a lot of discussion around different shareholder distribution policies and specifically dividends. As you think about the tightness in the LNG market that all of us and all of you expect, how do you think about dividends that you may be paying your shareholders over the next several years, and how does that fit in the context of your balance sheet strategy and what's happening in the market?
start. I mean, for us, dividends have been a very important part of our strategy, let's say, on retaining and securing the returns that the shareholders want. So I think we have had like 59 consecutive quarters of dividend payouts, amounting to a total of 1 billion. I think we'll continue to do that, but always, keeping in mind that growth is, we have to balance against growth. I don't see, significant, I would say, trend toward reducing dividends. I think, dividends are important. They are our shareholder base needs them in order to stay with us. I think that's the bottom line.
Yeah, from our side, we are paying 75 cents per share. Quarterly basis translate into $40 million per quarter. We have certainly no plans of cutting our dividend. We have, I think we ended the year with $200 million of cash, and then we have certain refinancings now, which will add another close to $100 million in additional cash on our balance sheet. So it's super liquid in terms of liquidity. We also have pretty healthy backlog. So we have most of our ships now on fixed rate hire, but we also have 3 ships on index. So when we do also expect that the spot market will start to reflect the term market, we will be making more money on those variable hire contracts that we made a lot on during Q4 when the market was super strong. So in line with the kind of the companies here in the John Fredriksen group, Frontline, Golden Ocean, SFL, we like dividends. That's our main vehicle of returning capital. We have also done some buybacks in the past, but we are now focusing on paying regular quarterly high dividends to our shareholder to return our excess cash.
For us, Cool Company is obviously a newly formed company. When we raised the equity back in January, we committed to paying quarterly dividends from US listing. We're certainly cash flow generating, so we could consider to start one earlier. We expect to be US listed during the second half of this year. When it comes to Golar, we currently do not pay a dividend, but we have cash and marketable securities of $1.5 billion. We trade at net interest-bearing debt to EBITDA of less than 1. But our plan is to start a dividend when we take delivery of our FLNG unit, Gimme, which will start its contract in Q4 next year, where we have a 20-year contract to BP. After that, we have sort of stable infrastructure-like returns for a long time, and at which point we would advise the board to start a dividend.
And in GasLog Partners, which is the publicly listed MLP that we have, we're paying a relatively, well, let's say, very small dividend now. We halted or stopped the payment dividends because we really needed to and wanted to put the companies in the fittest position on the balance sheet part. So we're dedicating our capital structure to reducing our overall leverage, and we're also actively buying back pref at the back of a very strong growth, both for the GasLog and the GasLog Partners. If the market continues as it is, and if we're, especially as we see also our currency or shares coming up to, let's say, levels that are more acquainted to the evaluation that we see, then I believe as we continue the leveraging and creating equity value, then we definitely will look forward to reviewing our dividend policy again.
Great. Thank you. I think we are coming right up on the hour here, so it's probably a good time to conclude. But thank you to all the panelists for joining today. I think it's an extremely important topic in light of everything happening in the world and in the importance of LNG to the energy mix. So thank you all, and Nicholas, I'll turn it back to you.
Well, all I'd like to say, Christa, thank you to you for the expert moderation, and thank you, Spyros, Paolo, Karl, and Oystein. Great discussion, and as Christa mentioned, in one of the most critical topics today on everybody's agenda. So thank you very much for being with us.
Thank you.
Thank you.
Thank you.